Kia ora koutou, ko tongariro toku maunga, ko taupo te moana, ko Ngāti Tūwhare toku iwi, ko Joe Kelly toku ingoa. I am Joe Kelly, the Chief Executive of Toitū Tāwha, the Centre for Sustainable Finance. Warm welcome to everyone to this introductory webinar on sustainable finance in the food and fibre sector, brought to you by the Centre for Sustainable Finance, Fit for a Better World, and our colleagues at the Aotearoa Circle. It is my pleasure today to introduce some of the Centre's founding partners in alphabetical order, starting with Dean Spicer from ANZ, James Patterson from ASB, Adam Coxhead from BNZ, and Joe Fibre from Westpac. In 2021, these banks accepted the challenge laid down by the Aotearoa Circle and joined with other financial institutions and philanthropic funders to establish the Centre as an independently governed charitable trust. The Centre's purpose is to accelerate progress toward an equitable, inclusive and sustainable financial system, as outlined in the Sustainable Finance Forum's 2030 Roadmap. The forum was convened by the Aotearoa Circle and it synthesised the views of more than 200 market participants over a 2-year process to develop the roadmap. A key role that the Centre plays is to enable pre-competitive collaboration alongside government to adjust the rules and norms of the financial system and mobilise capital into the low emissions transition. I'm also pleased to welcome Yuri Smith from Rabobank, along with Jack Keys from the Aotearoa Circle, who will set the scene for us, and our moderator today, Jenny Cameron, who will frame the relevance of this work to achieve the vision for New Zealand under Fit for a Better World. As we are all well aware, finance is a crucial enabler for progress in the real economy. Aotearoa New Zealand cannot self-fund its transition to a low emissions economy. We are an exporting nation built on the strength of our food and fibre sector. Our economic value proposition and trade partnerships depend on strong sustainability credentials and keeping in step with the rapidly changing expectations of the rest of the world. We need to compete for international capital, customers, and credibility. I invite you to join me in beginning this discussion by acknowledging Mother Earth and every living creature of the environment upon which we all depend. I pay respects to tangata whenua, and I also acknowledge our rural communities, all of whom are intricately woven into the fabric of our economy now and in a net zero by 2050 world. I'd like to remind our speakers today that as competitors, you need to be mindful of your obligations under the Commerce Act, and in particular, you should avoid sharing commercially sensitive information like pricing or discussing matters like market allocation. To our guests, if you have questions during the webinar, please submit them via the chat and we will endeavour to answer them at the Q&A session at the end of the webinar. Also a reminder that this is the first in a series of webinars focusing on sustainable finance in the food and fibre sector. Any questions we don't get to in the allocated time will be used to inform subsequent sessions. And Jack and Jenny will provide more information at the end of the session. Over to you, Jack.
Kia ora Joe and tēnā koutou everyone. Ko karangahaki te maunga, ko waiho te awa, ko paroa toku he kāinga. No Manawatu me Ingarangi o Kutipuna, he kaitohu whakatinana o e Aotearoa Circle, e noho ana o e Tamaki Makaurua Naine, ko Jack Keys aho. It's a real pleasure to be able to be part of opening this session alongside Joe. I represent the Aotearoa Circle as a Director of Implementation, leading our agri-food and tourism work streams. And it's really exciting to see such uptake on this event, such a large and diverse audience here. So taking a couple of minutes to help set the scene and provide a bit of context, I first want to acknowledge Vicky Robertson, a founding guardian, who I believe I saw pop into the call, in addition to any of our other guardians who have joined, and importantly, our partners. So those partners of the Aotearoa Circle are critical, as the Aotearoa Circle, for those less familiar, are at its centre a public-private partnership, with many of those from government agencies and industry organisations joining us here today. Our vision is to empower the sustainable prosperity of Aotearoa, and that's through our mission of restoring natural capital for future generations. And we achieve this by working at a system level. bringing the sector together to work on major projects, including collaborative events like this one. And that's where I'd like to give a special thank you to our banking partners and other collaborators for contributing specifically to this session today. The other bit of context I'd like to speak about is the why and what's led us to this point. Building on Joe's opening comments, and I think expect Jenny Cameron will build on this a little further. But this year, 2 of the Aotearoa Circle's landmark reports, the Agriculture and the Tourism Climate Change Adaptation reports, talked about access to capital for environmental investment and climate change adaptation as one of the very top priorities. Through the process, it was acknowledged that there's been really great progress made here in Aotearoa, and that's been championed by many of those you'll hear from today and on the call, but that there's still more opportunity. We heard some of the challenges in the agri sector, including awareness, verification costs, opportunities for technology enablement, more streamlined and getting more value from the data. And we heard about the urgent need to progress the system and framework for sustainable finance to allow faster investment into these crucial areas. So as a result of this context, the webinar, as Joe said, is the first stage of an initiative where the Circle will be working alongside our partners and the collaborators to identify other enabling actions, while also beginning the draft of an industry guideline document. And so we'll be hosting sector strategy sessions in late November following this event, and we'll look forward to having many of you involved in those conversations, and we'll be giving more details about those at the end. So thank you again. We're really pleased to have such an engaged group here. Like Joe said, use that chat function for your comments and questions, and enjoy the presentations that we've got in front. Really looking forward to hearing it all myself as well. So without further ado, I'll pass over to you, Jenny.
Kia ora, Jack. Kia ora tātou. Ko rimutaka te maunga, ko Manawatu te awa, ko Cameron toku whānau, ko Jenny toku ingoa. Kia ora everyone, my name is Jenny Cameron and I'm the Chief Transformation Officer for Fit for a Better World with the Ministry for Primary Industries. So really excited to have you all here today, and it's going to be a remarkable hour across, or an hour and a bit, as we delve into this really important and consequential area. We've got over 150 on the call so far, and we're expecting a few more over the next couple of minutes. So it's been a really well subscribed webinar and is attracting a lot of interest from financial sector, agri sector, energy sector, as well as government and non-government sectors. So I think it shows that there's a lot of interest in what is happening in the finance sector globally and domestically. So we're co-sponsoring this event as Fit for a Better World because what is happening in terms of the financial sector is of critical importance for our food and fibre sector, both as an enabling function and also as from a global understanding, and also that domestic setting in terms of assisting the transition and understanding where the drivers of change are coming from. Particularly as the financial market is a significant investor into the food and fibre sector. As at July 2023, it was 63 billion was invested by the finance sector, majority of that debt being held by banks. So it's important not purely as a transactional approach in terms of for farmers and growers, fishers and foresters to understand what their investor is going to be looking for, but also because the financial sector has an eye to the future trends as well, current and future trends. So Tessa Tennant, there's a good quote from her, who set up the first of its kind of an environmental investment fund in Europe in 1988, had said that finance was like a bird's eye view across the whole economy. From finance, you can start to see everything. And someone else, where the quote isn't attributed, but I thought it was quite good in terms of saying money is information about the future. And we certainly see that in terms of how it can influence the drivers of change. So for a number of you on this call, I know that you will follow very closely what the bank's settings are in terms of interest rates, but also where they're going in terms of sustainable linked loans and other things. But often we see it in a piecemeal fashion. So when Joe and Jack, when the Centre for Sustainable Finance and Aotearoa Circle and I were talking, we thought the benefit and the opportunity of this was getting a broad sweeping view from the different banks of the settings and how they're all seeing it from that pre-competitive landscape, and then also how they're looking at the different approaches they're taking for that, so that we can start to understand the settings across the board rather than from a piecemeal fashion. So understanding better why financial sector is making the shifts it is, in terms of that financing for a low emissions resilient economy. I know there are the skeptics out there who think that it'll all just, how permanent are these shifts, or where are the big drivers coming from? Is it permanent, or is it going to be transitory? Is it a trend or otherwise? But also how they're doing it and the different approaches they are taking and how that is evolving as well. As reminded, there will be Q&A at the end of the session. Please put that into the chat. And if you can, please direct who you would like to answer that question, because you will see there will be quite a few speakers as we go. So first up, we are going to start global, and then we'll come down to more domestic and practical at the end. So first up, looking at drivers for change on that international setting, we have Jura Smits from Rabobank. Over to you, Jura. Thank you.
Thanks, Jenny, and thanks for the introduction. And I'm stealing your quote in there to start off with a quote that I found on the website of the European Central Bank, which in our case is our regulator. And it says, climate change possesses risk to our economy and the financial sector. We need to assess how climate change and the transition to a carbon neutral society affects our economy so that we can account for the influence on our work as a central bank and a banking supervisor. My name is Jura Smits, and I'm Regional Head for Sustainable Finance and Food System Transitions for Rabobank across Australia and New Zealand. And as a Dutch cooperative bank, we're predominantly focused on the food and agri sectors at a global level, and increasingly focused on the energy transitions as well. In New Zealand, we're probably most known as a large agriculture lender. In the next few minutes, I'll address a couple of observations we see from regulators, from corporates, and our farming clients, of course, and how commitments and target setting are shaping sustainability in the food sector. I'll also try to address a few examples on that. As a European bank, Rabo has seen, as I just quoted, has seen an increasing level of engagement with the regulator and reporting requirements as well that come with that. Not only are we required to map and fully understand the climate-related risks, we're also required to have detailed plans and a level of action that take support of that transition going forward. As part of that, we have mandatory but also voluntary reporting requirements. So similar to the New Zealand context, in the European market, there's the Corporate Sustainability Reporting Directive, which requires banks and large corporates to report on climate-related disclosures. That's the same which will be applied in New Zealand starting next year.
Jura, can I just interrupt very briefly and ask you to turn your
Absolutely.
video on? I think we can't see you.
Is it off?
Thanks.
All right, that's a bit impolite. This better? Is this okay now?
I can't see you yet.
Was it working before at the start?
I don't know. Maybe if you keep talking, and we can see if we can try and find you. But if you keep going, but we can't see you at the moment.
That's a bit unpolite, of course, to everyone involved. This better?
Oh, I think almost.
Is it coming through?
Not quite. You're on the screen. No, we can see your name now.
Yeah, no, I stopped it and I turned it on.
Sorry, everyone. It might be the lag. Well, if you keep going, we'll see if it comes on a bit later. Thanks.
Yeah, let me know when it gets on. I'll keep on going. I think from a reporting perspective, it's important to understand the various frameworks that are out there. Some of them are mandatory, some of them are voluntary. So the key changes we've seen over the last few years are related to companies, big corporates aligning to the Task Force for Climate-related Financial Disclosures and combining that with global reporting initiatives. More recently, also the Task Force for Nature-related Financial Disclosure was launched during Climate Week in New York. These frameworks are aimed to develop standards to meet information needs of predominantly investors and outside stakeholders and deliver common language of sustainability and related disclosures around that. More and more companies are adopting those frameworks, which will make it much more clearer for investors to understand how ESG is embedded in their strategies. And since June this year, the International Sustainability Standard Board, or better known as ISSB, launched its accounting standards, where we will see sustainability-related disclosures to be embedded into financial reports. Some countries are now requiring that to be mandatory, like New Zealand does, and also Australia is working on a consultation piece to have that embedded in financial reports. So the more companies are going to report, the more clear it will be what they're doing, but it also means that they have to work with their value chain, both upstream and downstream. They have to get the data of emissions, of other elements related to nature and climate, to completely report under the requirements of what their investors require. So how are stakeholders now going to be able to be benchmarked, and how are commitments and targets going to feed into that? Rabobank is, as many other banks in the world, aligned to the Net Zero Banking Alliance, which is a UN-led initiative where banks are committed to transition their portfolios to net zero by 2050. As I said, all of the Australian banks have signed up to that, and so does Rabobank. This means that we will set our priorities to reduce the climate impact and protect and restore nature around us. To make this a little bit in tangible terms, Rabobank has committed to reduce 12% emission intensity across our dairy portfolio in New Zealand. This is one of the priority sectors that we have defined as being crucial for our transition pathways. We try to do this looking at the Science-Based Target Initiative, another acronym I'll have to call out there, which is known as the SBTI. This is known as the core guidance that will set targets around climate-related disclosures. Corporates have the choice to choose a corporate pathway, which will reduce their targets on an absolute term, and for some food sectors, it's an option to set intensity-based targets. Over 6,000 companies have already committed to set science-based targets, or are in process to do, or planning to do that, with increasing number also active in the food value chain. You can see companies like Silverfin Farms and Fonterra who have committed to set such targets. That will have a big impact on agriculture producers as well, as the value chain emissions that come from farm level will feed into those larger corporates. And as those larger corporates are setting science-based targets, the farmers will basically also have to adopt and work together with the buyers of the products to reduce emissions. So rather going from farm to fork, this sustainability dynamic will certainly go from fork to farm. There's a huge task ahead, and I guess everyone is aware of the data challenges that we will face within that along the way. As a true cooperative bank, we believe that we can grow a better world together. We try to do this with our customers and our value chain partners, and we try to accelerate the transitions in the food system and energy. Together, we can reduce a negative impact on current practices in these systems and create a positive impact along that. For us, what is a food-proof food system? It's about feeding and not depleting. It's about regenerating and not degenerating. It's about having a positive impact from farm to fork. And it's also about sustainable diets. Healthy, nutritious, accessible, and fast-growing world population will have to be fed, and we will have to produce that food for them within planetary boundaries. So what does this mean, and what do we do in practice? As the financial institution, Rabobank has recently joined Agri, Zero, and Z, an investment partnership that is established between government and industry-leading agri companies to accelerate a rapid reduction of on-farm emissions. We're also seeing increasing demand from the industry to collaborate and create financial solutions together to incentivize their suppliers. to adopt more sustainable farming practices. We do this, for example, with potato growers in the Netherlands, where we teamed up with McCain to adopt regenerative farming and try to incentivize the adoption of that framework that the company has developed. We also have a biodiversity monitor in collaboration with the big dairy cooperative Friesland Campina out in the Netherlands, where we incentivize again farmers to adopt more biodiverse practices across their farm. And together with Friesland Campina, so together with the buyer of the milk, we will provide incentives on a financial front. We're also embedding sustainability targets in value chain finance solutions. We do that, for example, for Coca-Cola, but more and more companies are looking into that space as well. And we're trying to find innovative financing solutions to support deforestation-free soy coming from Brazil in collaboration with big UK retailers and traders. So we're not only active in the sustainability-linked loan or green loan market, but we're also trying to collaborate with sector partners. And I think that was earlier addressed in the introduction as well. This food system transition is not just only for the banks. This requires a full collaborative approach. And back to the ECB, we need to reduce those climate-related risk in order to ensure a complete, stable financial sector. Back to you, Jenny. And apologies for the video.
Thank you. Thanks. We'll get to the end of it. We'll get to the bottom of that later. Someone very nicely said maybe it was a slider across the camera. That's got many people before. Great, thank you for starting us off there. So next, now we're going to Dean Spicer and Dean Spicer from ANZ and Adam Coxhead from BNZ, who will talk more around the key enablers for the finance sector to enable adaptation and mitigation, with a specific focus on the food and fibre sector. Over to you, Adam and Dean. Thank you.
Yeah, thanks, Jenny, and kia ora tātou, ko Dean Spicer tōku ingoa. It's a pleasure to be part of this session and to share it with Adam. Certainly echoing a lot of Yuri's points he made, and that, I think one of the comments at the start is, is this a trend that's going to last, or is this something that's temporary? I think from an ANZ perspective, we see sustainability as a global mega trend. It is going to transform, or is transforming, expectation on businesses to deliver for their wider stakeholders. And I think the other thing to consider is, if we're to retain access to our key export markets, then we need to deliver on the expectations that are now encompassed in free trade agreements. I think the other point I'll quickly make is, New Zealand imports a lot of capital, and that's largely through the banking system. As you said, there's expectations on the banks in terms of their financed emissions. And as we look to access global capital markets, the expectation on investors who fund the banks and who ultimately fund a lot of businesses in New Zealand is that we can show progress has been made. And so this is a broader global ecosystem change that's happening, that ultimately it's a big opportunity for New Zealand. It comes with some challenges, but I think we can embrace those challenges, and that will see us all in a much stronger position. We're focusing on the key enablers to the finance sector to enable adaptation and mitigation. It's a big topic. I'm going to throw to Adam, but one of the key enablers we see is that around data capture, methodology, and sort of how we can use that data. So look, Adam, over to you to sort of lead this section off.
Thanks, Dean, and kia ora tātou. I'm Adam Coxhead, the Head of Sustainable Finance at BNZ. It's a pleasure to be with you all today. So as Dean said, probably the foundational enabler for sustainable finance in any sector really is data. It's the foundation for good decision making, to assess where things are at, what progress is being made, and the effectiveness of changes being put in place. It needs to be reliable, able to be efficiently gathered and measured on a consistent methodological basis. So those are the key attributes for data across all sectors, and not least for food and fibre. We do need to be cognizant, I think, particularly at this time when farmers have a lot going on, a lot on their plates, navigating the economic environment, interest rates, inflation, increasing regulatory and compliance demands, that we're not asking for the same information in 5 different ways from 5 different interested stakeholders. So that's an important consideration. And I think, where we really need to get to is that we have an efficient way of collecting and gathering the right data that provides access to those that need it in a sort of singular format. The way that data plays into sustainable finance a good example of that is through sustainability linked loans. Now, all the major banks are providing these on a tailored basis, to large agribusiness customers or to, value chain primary sector customers, and data plays a key role in measuring and reporting on some of those KPIs or targets that you have in these sustainability linked financing arrangements. At BNZ, we also actually have what we call a scalable sustainability linked loan for farmers as well. So that is for smaller farming businesses. They can access that same sort of incentive-based financing arrangement that helps drive towards achieving their sustainability goals. So data is a key part of that. And as I said, trying to align the data gathering and reporting for those sorts of sustainable finance instruments with other reporting that farmers are required to do through to their customers is important as well. I'd also like on the data point to highlight that whilst emissions are obviously important, rather than having a singular focus around emissions, we need to think more broadly. And for example, biodiversity is increasingly going to play a role in decision making and investment or commercial opportunities in the future. So we need to have that lens as well. Maybe just to round out this part of it, a related enabler for sustainable finance in the food and fibre sector is really around consistent definitions or taxonomies. So taxonomy is really a definitional system for activities that are considered green or sustainable. It's important that not everyone has their own definitions of what these things mean. Hence the development of national or international frameworks around this stuff. And whilst there will be local market nuances that need to be considered, for example, in New Zealand, we have a different type of farming system typically than many other parts of the world. It is important to align as far as possible with some of these international frameworks, in particular for those markets that we're selling our food and fibre into. Australia, UK, EU, Asia, they all have taxonomies or taxonomies in development. So as we move forward with trying to develop New Zealand specific definitions, we need to be cognizant of what those international frameworks look like. Again, these taxonomies are useful for banks, not only banks, but investment managers, the finance sector as a whole, in defining clear boundaries for green financing products. For example, on what sort of on-farm investments like fencing or planting of waterways or wetlands might meet those definitions for green and sustainable activities. Maybe with that, Dean, I'll hand back to you, and you can provide some views on the applicability of some of these data and methodologies on a practical level.
Yeah, thanks, Adam. And look, I think I'd just note, and what you touched on, and that is perhaps some of the challenges initially around capturing data, and it can feel quite onerous at times when businesses starting out in this process. And look, the market, sustainable finance market is relatively new, so there's a lot to learn. But I think there's signs of improvement coming in terms of tech solutions as well in the data space. But just one thing I wanted to just highlight is that there is an increasing focus across the supply chains and supply chain traceability, and that's particularly important for the food and fibre sector in particular. Buyers of these products are wanting to have confidence in the provenance of the products they're buying. There is the scientific know-how and audit methodologies in place to prove proof of origin for food and fibre products. And I actually think this is really valuable for New Zealand producers, particularly those who are striving to deliver best practice standards and meet sustainability initiatives, because it will become easier for them to prove out the provenance of the products that they're producing. I guess the flip side of that is that potentially perhaps poorer producers will become more transparent, and therefore there are some risks for those producers in terms of being able to access markets for their produce. This goes beyond environmental considerations as well, and the focus on the supply chain also touches on social impacts like the modern slavery considerations. The other development, just briefly, that touches on data as well, comes through the developments in payment systems that is likely to come in the future, that will include or incorporate smart contracts that will support the development of nature-based assets like carbon credits and biodiversity credits, and potentially capture data on sustainable agricultural practices. So I guess the blockchain technology and tokenization has the potential to play a significant enabling role in addressing climate change, sustainability, and decarbonisation. As a bit of an example, ANZ has tested this recently through the purchase of an Australian carbon credit through a smart contract linked to a stable coin, and has subsequently tested out a cross-jurisdictional, cross-currency test on a transaction for a reef credit, biodiversity reef credit. So this is sort of new developments, but I think the point I'm trying to sort of highlight here is that data and enabling technology is going to be really valuable in supporting producers who can deliver high quality produce sustainably. So look, Adam, I'll pass back to you to sort of pick up on the adaptation considerations.
Yeah, thanks, Dean. Actually, just to link back into what you're saying about supply chain traceability or transparency, that can act as an effective commercial driver for sustainable finance as well. So when you think about implementing sustainable financing in the food and fibre sector, you got to think about what are the commercial drivers for actually making that investment or undertaking that activity. The commercial drivers can be things like customer demand or market access, or improving the provenance of a product that you're selling into different markets. It could be valuing carbon reduction or sequestration, or valuing biodiversity, as we touched on previously, mitigating the impacts of extreme weather events, so a risk mitigation sort of commercial driver, or in a similar way to insurance might mitigate those sorts of events as well, or ensuring your business model remains resilient to future changes. For example, increasing pasture diversity as a resilience measure, and that can play into sustainability-linked loans as well. So, for example, you might have targets within a sustainability-linked loan or bond structure that align to some of those commercial outcomes that you're trying to achieve with those investments. So having those clear commercial drivers can help to secure finance for those investments, whether they're mitigation or adaptation related. I think the commercial drivers for adaptation aren't always as obvious. And I think, when we were discussing this previously, Dean, you had a good example of how you think about that. So maybe I'll pass back to you.
Look, this topic is a big topic and quite challenging. I think I was quickly going to just highlight a paper that the Ministry of the Environment's commissioned and is available online, titled "Adaptation Finance: Risk and Opportunities for Aotearoa New Zealand," and Dr. David Hall was the lead author on that. And that paper highlights something that was mentioned at the start, and that there is a adaptation financing gap for New Zealand, and that's not likely to be a gap that can be funded solely by central and local government. So I think what's clear is that we need to crowd in different funding sources and diverse sources. The paper also asked the question of, looking at who pays risk transfer instruments and the enabling rolling of government policy. So look, I won't spend too much time talking on further on that paper, but it is a resource there that may be of interest to the audience. I think when we think about adaptation, we need to also think about building infrastructure that rather than just being stronger and bigger in the traditional way of building grey infrastructure, there is growing evidence that blue-green infrastructure or nature-based solutions can be more effective and deliver additionality in terms of co-benefits. And so a study by the Nature Conservancy in the US found that nature-based solutions delivered up to 5 times the cost in terms of benefits. And so that also was taking into account co-benefits around nature and community impacts. Looking at a local example that Auckland Council has developed at Oakley Creek here in Mount Roskill, it's an example of a 1.3 kilometre stream that was a concrete channel and has been developed into a wider naturalised stream through the planting of thousands of native trees that were actually grown at a local school. And that increased the stream's capacity to deal with extreme weather events better, to soak more water in terms of into the ground and store it. It was a win for the community in terms of creating a green space that can be utilised as well, improving nature outcomes and biodiversity, but also it's an ineffective infrastructure that is performing better than the traditional infrastructure was there. So I think it's an example of what can be delivered at regional levels. I think the scientific research suggests that wetlands can also be effective in terms of storing significant amounts of water during high rain events. That is also has an applicability as an example of on-farm sort of infrastructure that can be helpful to consider. Again, in terms of financing, ANZ does have a business green loan that includes a sustainable land use category that can be used to fund the planting of wetlands. So again, I think it's something that we probably need to explore further is innovations around the way we think about infrastructure, and also exploring what is working in other locations and seeing where that can be applicable to New Zealand as well. So that was sorry, Adam.
I was just going to say that's a terrific example, Dean, of changing sort of how we think about things like wetlands and thinking about them as infrastructure that helps with improving resilience as a risk mitigation tool. So that really highlights another enabler in my mind, which is knowledge and awareness and capability uplift. And as banks, we're an important partner on the journey of mitigation and adaptation for our customers. And it's important that all of our bankers have the right knowledge and capability so that they can talk to their customers about some of these issues in a meaningful way. So as an enabler for more sustainable finance activity and therefore more sustainable practice on farm and through the agri sector, I think improving the capability and awareness of our colleagues, but also our customers is really important. And that might be sharing case studies or stories like the one that you've just shared, Dean. It might also be opportunities to partner with some of our primary sector producer customers to advance awareness or understanding of some of the options across common value chains. So it might be the producers bringing best practice examples to their suppliers, alongside a bank bringing a related sustainable finance solution that integrates with that best practice. Some of the sort of collaboration around best practices can be seen. An example of that is Fonterra's net zero farm that they have in partnership with Taranaki Iwi Trust and Nestle. There are other examples of that. I think around producer incentives that we that we're aware of as well. Dean, maybe I'll hand to you on that point.
Yeah, look, I think it's a good point in terms of the knowledge sharing, and industry pilots are a great example of the ability to enhance knowledge through learning and sharing of approaches that may work, and indeed those that perhaps aren't so effective. So, that test and learn is important. I think the producer incentives are helpful because ultimately they are in touch with the end buyers of products, and so if they can provide incentives that demonstrate or incentivize what good looks like, then that's really helpful. Ultimately, as we sort of touched on, New Zealand has the opportunity in terms of enhancing its brand. When we look at some of these measures at an industry-wide level, then it's important that there's a signal in terms of what is expected from consumer markets. I think, as you touched on, Adam, the sustainable finance market can then play a role as well through sustainable loans to the producer companies to align with their sustainability strategies. So I think that alignment of outcomes is really helpful if it can filter right through the industry and give clear direction to growers and farmers. And look, you started off with data as an enabler, and I think one of the things that we would end on would be transparency that comes through climate reporting that's in focus at the moment. So look, with the few minutes left, I'll pass back to you to pick that one up.
Thanks, Dean. I think Ure really covered this off in great detail earlier, which is climate-related disclosures are an enabler of the use of sustainable finance, or the scale-up of sustainable finance as well, in that they spotlight both risks and opportunities that will lead to investment cases being more compelling for some of these projects and investments around sustainability initiatives. In New Zealand, that turns up in the XRB regime, which captures on a mandatory basis roughly the top 200 businesses and organisations across New Zealand, including the banks, insurers, asset managers with balance sheets over $1 billion, as well as listed companies with a market cap over 60 million, I think it is, and a lot of government organisations as well. So there's a broad range of organisations in New Zealand that will be subject to this mandatory climate disclosure regime that will lead to those organisations having to identify metrics that are relevant to their key sustainability issues or climate-related issues, and set targets around those as well. So these disclosures are an obvious enabler for more use of sustainable finance and related investments across the food and fibre sector, for sure. Whether you're captured directly by that regime or not, it's going to start to flow through into the value chain of those companies that are captured. So with that, perhaps we'll leave it there on the enablers discussion, but thank you very much, and I'll hand back to you, Jenny.
Thank you, Adam. Thank you, Dean. Really great insights there, and lots of food for thought as well as we digest all of that. I think that's there's a lot of technical aspects of this, as well as the just the enabling functions. Is really great to get some of those practical examples. So thank you for that. And speaking of practical applications, we will now head to discuss that a lot more, and we are going to be joined now by James Patterson from ASB and Joe Fibre from Westpac. Thank you.
Thanks, Jenny, and kia ora, everyone. I'm going to kick us off. I'm James Patterson, Head of Sustainable Finance here at ASB. Firstly, thank you to the Centre for the opportunity to speak today. As Jenny said, Joe and I are going to cover really how sustainable finance comes to life with purpose and application for the food and fibre sector in New Zealand, and bank capital being a really critical enabler of market access, of transition, of adaptation, and of forward innovation. So for my section crudely broken down the sector into two broad categories, one being the bigger end of town where we see the large processors as sort of corporatized, institutional sized businesses, and then also what we're seeing within our mainstream food and fibre producers and some of the products and initiatives that will support those. So if we start with capital in the big end of town, we've seen really steady activity from corporate borrowers in the sustainability linked loan market that Adam and Dean were describing, where basically loans are structured to perform not only against their historic financial metrics, but embedding environmentally and social-based targets within those. So what we've seen, the common traditional measures we've seen within those markets have been greenhouse gas reduction, and historically that's been largely scope 1 and 2 emissions, but we're really seeing an increased prevalence of incorporating scope 3 both on a gross basis and on an intensity basis. And obviously for the food and fibre sector, which is a volume export sector, that's a really important distinction. So there's no unintended consequences there. We're seeing a lot of KPIs around waste and packaging reduction, water, efficient water usage, and really critically the social factors which can't be left behind, and that looks like workplace diversity, work conditions, including all the modern slavery considerations, employee development, etc., etc. So one thing that's important to note within these structures is they really need to move beyond compliance and BAU. So they have to push a business, they have to be ambitious, science-based, and really fit hand in glove in with strategy. So you'll see in most of these structures in the sustainability linked loan space that they will align to national and global climate targets and United Nations Sustainable Development Goals. As I was saying, they should fit hand in glove within a business and not be incremental to a lot of what's already going on within strategy and culture. One shift we are seeing is, as Adam touched on, is a movement from borrowers to try and incorporate aspects such as biodiversity, so water ecology, erosion control, waste management, animal welfare, including heat stress, and support of industry, within contribution to research and development spend when we think of methane and other issues, specific to the food and fibre sector, and also community impact of operations and, business contribution to things like rebuild of climate impacted areas and the broader ethos around social. I think a challenge around embedding new KPIs has nearly been, to go back to another point around data, is the relative immaturity of data in measuring these aspects. So when we look at biodiversity, we can plant trees, we can fence waterways, but it's quite hard to measure the impact of those within the life cycle of one of these facilities. So, and they are subject to, flood can impact the water quality outside of best efforts of a borrower or a company. So that will be a forward market trend in that market. Another observation would be that recognising that consumer scrutiny, that end market scrutiny, and we are seeing some conditions within these loans aligned to some of the global structures and some of the supplier frameworks that have been developed by the likes of Fonterra, by Silverfern Farms, by Synlait. Really importantly, these facilities do require, a large commitment in terms of resources. There's verification, there's stakeholder materiality, and that comes at a cost. And so whilst there are margin incentives for hitting these targets, so there's plenty of carrot, I think there is a broader recognition now that it's more than pricing. It's another mechanism to tell your story to the market and really engage your stakeholders through your financing of the principles you hold your business to and how you are going to go to the market within this area. Just to bring it to light with a few examples of recent issues we've seen in the SLL space in New Zealand, we've had Pamu, had Silverfern Farms, Craigmore, Southern Pastures in the horticulture space, Seeka and Trevelyan's, and in viticulture with Yealands. Just moving on to the more mainstream food and fibre borrowers, we sort of go beyond that really structured SLL space to a bit more of a use of proceeds and needs approach there. So we've seen focus there being really investment in farm climate and biodiversity, adaptation and mitigation. How do we protect ourselves going forward? How do we deal with erosion? How do we deal with crop loss, heat stress? Electrification and alternate energy is something else that's certainly bubbling up, but in terms of solar installations. How do we heat and cool our valuable produce, and how do we integrate and isolate ourselves from increasing energy costs that we're experiencing globally? We're also seeing that investment into biodiversity and animal welfare. From an ASB perspective, how that's played out, we have a rural sustainability loan that's been embedded in a broader business sustainability loan product now. But looking at the data we had from that, we saw 23% of the volume that was drawn on that going into planting and fencing, broadly 20% into water protection, 20% to effluent, 17% to stock exclusion or fencing, and then 14% into animal welfare, and the remainder into solar. How are we measuring those, or what we're requiring customers to work with us on is, how do you benchmark good? And we're able to draw on a lot of industry and customer data in doing that. A key one being farm environmental plans. As at our last financial year end at ASB, 52% of our rural customers had farm environmental plans in place, and obviously we're working and engaging with those going forward. Animal wellbeing plans, freshwater farm plans, alignment to those processor standards, alongside those traditional know your number requirements. So the benefits there, of these structures are either financial and then non-financial. So the financial ones obviously being the pricing of the capital itself, but as we invest in adaptation, resilience, and better systems, we start to see that playing through in terms of the financial performance of these businesses and their availability of, their ability to access capital at reasonable prices and really underpin their future growth going forward. It also helps with the engagement with suppliers. Obviously, suppliers have got access to end markets, but those processors are increasingly demanding more of those that supply to them. Attraction and retention of staff is another key one. Longer term access and pricing of capital, as I've touched on. So I guess when we look forward in the market, what's required, what are the next steps? Well, a lot is clearly going to be around how do we innovate, how do we fund future adaptation, what about the technologies to reduce methane, to work to keep the sector operating at a level that's acceptable to keep access to those global markets. So we look at early stage investment models and how banks and other capital providers can assist those. And ASB was proud to release last week ASB Access, which is an early stage funding model to help some of that innovation within high potential food and fibre businesses, and look to draw back on some of those traditional barriers that they have faced within funding markets. We also look at how we partner beyond banking models with other key stakeholders in the market to enable better access to capital and greater resourcing around food and fibre and New Zealand's ongoing access. So with that, I might hand over to Jo to give her Westpac perspective, and thanks everyone for the time.
Kia ora koutou, ko Joe Fibre toko ingoa ki Westpac aho e mahi anō, tēnā koutou katoa. Thank you for the invitation to speak today. As James said, I'm following on with some of this practical application as well. So my role within the Westpac agribusiness team has a focus on research and specifically on delivering sustainability insights to the national agribusiness team. So I'm going to take you through Westpac's practical application of sustainable finance. So as the previous speakers have noted, consumer demand in global markets will drive the change. New Zealand needs our products to meet the needs and the visibility of the increasing labelling requirements of global markets and ensure that we can access all markets and attract the prices that we want. So food and fibre creation is a highly competitive global market. New Zealand may be the lowest emitting dairy producer globally, but others are catching up and they have some pretty big levers that they can pull. So we need to maintain our competitive advantage. At Westpac, our investors and our stakeholders are telling us they want to see that we're managing climate-related risk, managing that transition risk, and have confidence that the sectors we're lending to have these risks covered. So we're here to support our customers in the sector to maintain their competitive position and the access to their markets. Through our sustainable lending products, we're helping our customers develop sustainable, future-focused and resilient farms. This supports them to demonstrate they can meet the changing needs of the local and global market. And at Westpac, we reward them because that means we're working together for greater outcomes for the sector and for New Zealand. Now, in terms of Westpac's practical application, this focuses on supporting our customers to meet the needs of their market and uplift their management practices so they can meet the requirements of their supply chain. We're here to support them with their transition as the sector, the technology, the data, as been mentioned, and the on-farm solutions evolve. Westpac's support is multifaceted, so from frontline managers, customer-facing ESG specialists alongside economic and scientific data. Right now, we're focused on supporting customers with on-farm management practices through our whole of farm sustainable farm loan, which is available to farmers across all agricultural sectors. So prior to the launch of this product, Westpac took the time to study the science, work with farmers and pilot the program. For those farmers not quite ready to tackle the whole of farm, we also offer the sustainable business loan to fund sustainable assets on farm, covering the whole raft of options: renewable energy, recycling and waste reduction, native forest planting. And we firmly believe that management practices will enable our customers to progress a long way to reduce emissions and enhance broader sustainability outcomes that both their and our stakeholders are demanding. And this covers the full ambit of reducing emissions, improving water, soil, biodiversity outcomes, and ensuring climate change adaptation is front of mind to build these resilient businesses. So in terms of the science that I mentioned, last year Westpac and Lincoln University released research that finds agile farm management will be critical in reducing emissions and adapting to climate change. This research assesses the risks and opportunities presented by climate change, as well as the sector's vulnerabilities and potential responses. That report is available on our website publicly, so please do take a look. The work was designed to provide Westpac customers and other farmers and growers impartial information about the way climate change may affect their location, type of production, and also give ideas or options about how they can respond, including their future farm investments. The first step in adapting to climate change is identifying and understanding the risks and then working through what options farmers have in order to adapt, transition and build resilience into their businesses. The report makes the information relevant to the farmers and growers, exploring credible case studies. It looks at the effect of drought on a dairy farmer in Canterbury, the impact of warming winters on kiwi fruit growers in the Bay of Plenty, and the impact of back-to-back drought years on the sheep and beef sector across New Zealand, and also explores the opportunities that may arise for producers that adapt quickly. In some cases, land may be suitable for different types of production that were not previously viable, and this helps build the diversification and resilience at a farming system level. The conclusion of the report was that New Zealand's 10% methane reduction target by 2030 is achievable. We know that markets and the pace of climate change will demand more than a 10% reduction, and we're confident that the finance sector can help our customers accelerate to meet the needs of increasing levels of performance that are required. A huge number of our customers are thinking about the long-term view of their farm's futures every day, and we see the incredible changes that they're making. To give you an example, our farm is a joint venture between St Peter's School, Cambridge, and Lincoln University, alongside other funding partners, including Westpac. Our farm's aim is to provide leadership and try a multitude of on-farm initiatives with a particular focus on the environment. Other farmers can learn from this and maximise their investment on farm with greater certainty of success. So our farm is really out there demonstrating and developing excellence in farm performance to create the sustainable future everybody's after. They're demonstrating this in real time and can prove what really works. I would encourage you to visit their website, and they also have farm focus days for you to really understand and hear about what they're doing. The next piece of scientific information that Westpac's coming out with is a greenhouse gas mitigation report put together in conjunction with Juno Economics. This models greenhouse gas mitigation scenarios while also focusing on maintaining profitabilities on 4 types of farms. So really, from getting out there and talking to customers across the country, it is clear that farmers in New Zealand are rising to the challenge and finding ways to boost sustainability and reduce emissions across their business. And the Westpac Sustainable Farm Loan is a way to reward these customers for their work across the sector. And I will hand back to you, Jenny.
Great. Thank you. Thank you, Joe and James, for giving us a few more examples of that. So now we're into the Q&A section of the webinar, and everyone is doing amazingly well with time. So we do have a good period of this 20 minutes or so. So there's been a few come through in the chat, and I'll kick off by referring this to Dean as the largest bank with in the agri sector. How, bearing in mind confidentiality, commercial and confidentiality, what would you say the speed and uptake of these sorts of sustainable linked loans are? So we can start with you, Dean, but if anyone else from the banks wants to comment, that would be interesting. Thanks.
Yeah, thanks. Look, I think in the context that it's a relatively new product, and sustainable finance is really only sort of kicked off in New Zealand in earnest over the last sort of 3 years, and the uptake's been quite rapid, and that's true across the other products as well in terms of green bonds and the like. So I suppose my comparison there would be we saw in the New Zealand market overall a record year last year. When I look at the year-on-year change, obviously New Zealand's a small market in the global context, but the year-on-year growth has outperformed the global market over the last few years. So in that context, I think the uptake's been strong, and I think what we've seen is the companies who have been first adopters have been the larger companies, as you'd expect, who have more, perhaps larger teams who can therefore embrace change more quickly. But the challenge probably for us as banks is to sort of see how this can be developed further across the broader business setting. And so we've talked about that on the way through in terms of there are products now available across a range of customer sets for smaller businesses as well. And I think we're going to see further developments come in in that space as well.
Lovely. Does anyone else want to comment on scale and speed of uptake?
I think the only thing to add that, and this is reflecting the bond market in Europe, as we have good data on the bond market generally, that we see about 30% of the bonds have either a green or sustainability linked label, and that has grown rapidly from sort of 8% 2 years ago to 30% these days. It is relatively stable at the moment at that 30 mark, so it's not growing significantly faster at the moment, but I think it shows that one in a third issuers is looking to embed sustainability, social or green or blue these days as well, metrics into their bond structures.
Maybe just to add to that, Yure, I think that observation that globally volumes have been somewhat stable, I think playing into that has been a bit of a trend internationally for a bit more moderation in the sustainability linked loan and bond markets, in that there is a increasing focus around risks of greenwashing. So I think both issuers and banks and investors alike are all very focused on ensuring that these transactions or products are structured in a way that has credibility. So I think that sustainability linked market has moderated in its growth a bit, but is expected to pick up again, as Dean observed. The larger corporates with more resources at their disposal to measure and monitor the metrics required and to report on those on a regular basis are the ones that have probably moved earlier, and then as that becomes more embedded across the small businesses, we'll start to see more.
Thank you. So I'll direct the next questions to Yura. So first one is Rabobank going to introduce a sustainable linked loans for farmers in New Zealand anytime soon?
Look, we're assessing that and I think one of the key points Adam had mentioned is around the data point, and that's a crucial point to drive this market further. So to fully understand baseline and improvements as such, that's something that we're currently assessing, and how we can then apply that across our product range we have on offer for clients in New Zealand. Thanks.
And then a second question, you mentioned in your talk, and thanks, we've got your video, we've got your lovely face now so we can see you, is you talked about intensity and efficiency measures. There's also absolute measures, and this is one of the live conversations with SBTI, is are we looking for gross absolute reductions, or is it intensity efficiency? So it'd be really interesting to hear from some of you of how you're navigating that issue at the moment. Thanks.
Yeah, no, really good question, and I think it's if you read between the science-based target initiatives, the method they've got basically a default method that applies to all corporates, and for some sectors they've got specific methods, and that includes the forestry, land use, and agriculture sector. SBTI currently has worked out 12 commodities where they've got an intensity target. So if you're active in that particular commodity, you're able to use that, what they call the FLAG guidance, so forestry, land use, and agriculture, as the acronym. Companies up in the value chain are basically working out what is their FLAG. So supermarkets, for example, they're working out what is their FLAG-related emissions and what are the non-FLAG-related emissions. So basically, what part of their products have commodities that fit into those commodity buckets, and how can they tackle those elements? So, for example, if you look at the supermarkets, they will assess what part is in the dairy sector, because dairy is one of the commodities, and dairy has an intensity target, which basically requires a reduction on tons of emissions per tons of product. And that links into the fact that we need to produce food for a global growing population, and that takes that into account. So the FLAG guidance effectively allows the food sector to reduce 72% instead all the way down to zero in the current method. Where if you want to achieve net zero goals ultimately by 2050, you down the track would want to go everything down to net zero, but then the current trajectories and target setting that are out there, we're encouraging to use the flat guidance if applicable to a company.
Thank you. Does anyone else want to comment on how you're approaching that with your products?
I think Yuri's covered it well. I think generally what we're seeing is that it is we're probably following similar methodologies, given that flag guidance is relevant for this sector, but generally SBTI and science aligned targets are generally what we're seeing being incorporated into products. Ultimately, I think we're aware that we do need to see absolute emissions reduce. There are reasons why.
I'll get the protein chicken one more if they have it here. And all the ingredients.
Somebody's not muted. Thanks.
Yeah, look, and intensity-based measures have been incorporated from time to time as well, and there's rationale for that as a measure too.
Yeah, I mean, just to expand on that, one of the reasons that you might opt for an intensity-based measure over an absolute reduction measure is that having an absolute reduction measure can, create incentives just to reduce your exposure, whereas an intensity-based metric allows you to maintain or increase your investment in an area whilst as long as the emissions intensity of that investment or production is decreasing. So, and to just the question around using SBTI pathways or other pathways, one of the challenges with SBTI is that often the pathways that they are looking at might be a global pathway for a particular market segment or a sector, whereas it can be helpful to look at more regional or national specific pathways. And, as an example, in New Zealand, we have a Climate Change Commission who has been modelling out different decarbonisation scenarios, and they have a demonstration pathway that models out what needs to be true for the government's methane reduction target of 10% by 2030 to be achieved. And in modelling that out, they include a range of different assumptions, including an emissions intensity assumption for the dairy sector. So that's one useful data point from that scenario that can be used for target setting purposes.
Thank you. Next, I'll direct this question to you, Joe Fibre. So one of the questions was so as to avoid the duplication of data, which has been a consistent theme, and we know to avoid the data burden on farmers and growers and foresters and fishers to be implementing this, how are you looking at using existing industry programs in order to gather the data you need, such as Farm Assurance Plan, NZFAP or Global Gap or other things like that?
That's exactly what we're doing, to be honest, is, there's a lot of existing data out there. So where we can use verified data from other assurance programs, that's an obvious way to avoid the duplication. The burden of this sort of work shouldn't sort of outweigh the impetus to actually make the change. And so that absolutely is part of our program.
Thanks. Open to anyone else if you want to comment on that. We'll take it as given you're trying to work through that and work with the existing. Great, thanks. So next one is, I'll direct this to Adam. Are you looking at insetting versus offsetting and how that dynamic might play out, given whilst the food and fibre sector might create emissions, it's also going to be part of the solution for reducing emissions. Is that a live conversation happening at the moment around how to encourage insetting?
Yeah, look, I mean, it's a very topical point, not only in New Zealand but globally. I think there is increasing focus on the use of offsets to meet net zero goals. So I think there's increasing focus on not using offsets as far as possible. And if you look at the SBTI framework, the way that they sort of look at things is that you need to do everything that you can to reduce gross emissions, and then net zero means that you offset the residual that are very difficult or impossible to reduce, and that in their mind is somewhere around about 5% of total emissions. So that's what sort of net zero means to them. In terms of the agriculture sector in New Zealand and how that turns up, I think it is important that some of the tools that farmers have to sequester carbon on farm are recognised in the overall evaluation of the impact that their business operation has. So certainly I think that is a valid consideration when you're looking at the impact of agribusiness in New Zealand.
Thank you. I'll direct this to James. How do you see, in the global perspective, is adaptation infrastructure finance working, and is anyone globally doing it well that we might be looking to, or how is New Zealand placed in some of this green finance landscape? Are we leading, or are we fast following, or are we moving a bit too slow?
I think you always look to some of the European markets as really strong, examples of where investment in green infrastructure for adaptation has been very strong. I think New Zealand's unique in terms of obviously a pastoral farming system, most likely, in what we need to protect here versus some of the other geographies in the world. Obviously, and very much an increased focus around water security and investment there, consistency there. What are we going to do around increasing temperatures, both in terms of animal heat stress, and as Joe touched on, as climate scenarios play out and we see crop loss in horticulture, for example, how does that build out? So I think that will become, in that sort of green loan use of proceeds segment of this market will become a lot more prevalent. And I think, one of the big questions within it, or if you look at sort of project finance solutions, is how we structure and how we fund those as collective industries and as suppliers. And I think potentially that's been one of the missing pieces in New Zealand, is how we develop better blended financing structures to share some of that risk and provide the adequate capital for the scale that's required.
Thank you. Another question is around the how methodologies are moving, and what connections do you make between wealth, social, cultural, environmental, and financial well-being? Dean, you nodded first, so
I think it's a great question. So yeah, I love the question. I think, look, what's interesting, I think, is that we talked about the challenges of data, and this is probably in terms of the emissions reporting, for example, and that's probably where we spent the most time, have made the most progress. We realise, I think, that it's accepted that there's definitely a twin crisis, being biodiversity featuring on that as well. And ultimately, I think the work that was done initially by the Aotearoa Circle in terms of looking at the roadmap for sustainable finance is that you can't ignore social impacts. And so the whole concept of a just transition is a really important one. And I think we're going to see these things play out, and we'll be better at understanding interrelationships. Naturally, then tied into that is embracing the Te Ao Māori learnings that they can bring to this conversation. So look, I think we're probably at a very early stage in this whole journey, for want of a better word, and there's a lot of work to be done. But we need to sort of try to better understand the interrelated impacts that that span across those various aspects.
Thank you. All right, well, I think we'll wrap up the Q&A now. And thank you to everyone for the questions. If you want to carry on that conversation and you bank with one of these people round the table here, I would encourage you to follow up with your banking advisor and carry on that conversation. I will also hand over to Jack, who will talk to us about next steps in terms of those other webinars that was highlighted at the start. Thanks, Jack.
Thank you very much, Jenny, and all of our presenters. I first just want to say a couple of really quick thank yous. A special thank you to Fit for a Better World and to you, Jenny, for facilitating this session and managing to navigate through a lot of questions that were rolling in there, as well as those who were able to answer them from the panel. A special thank you to the Centre for Sustainable Finance, Toitu Tahua, for your involvement and help in putting this event on. And of course, to our panelists, presenters, the banking partners, for sharing your insights in this session. We got through a lot of those questions, and there were some big ones in there. Thank you for those contributing them. But there was even more continuing to roll in. So apologies that we didn't get to everyone's specific questions, but thank you to all of you in the audience for such strong engagement in today's webinar. We did send out a pre-webinar survey, and over 50% of the audience said they'd heard about sustainable finance, which you might expect signing up to this webinar, but they had limited knowledge. So I'm expecting after this session and hearing all of that, you can pretty much consider yourselves all experts on the topic now. But we will be sending out a post-webinar survey to understand what was most valuable, what's still left, where are some other comments or questions or areas that are important to understand. So keep an eye out for our post-webinar email. It will also have some links to the key reports that were mentioned by our presenters, and we'll make a recording of the session available as well. We're looking forward to continuing this conversation with you all. We will be hosting, like I mentioned, some strategic conversations late in November, sector specific, and we'll also put the details of those in that post-webinar email, so that we can pop those placeholders in the calendar and let us know if that's something that you want to be directly involved with. But otherwise, thank you from the Aotearoa Circle. It's been an absolute pleasure to put on this session today, and it looks like we're even going to finish up early. So I'll pass over to you, Jenny, just for any final closing comments before we end the session.
Oh, you're doing such a nice job wrapping up there. I thought my job was done. Thank you. So I think overall, hopefully you have become a bit more educated and enlightened in terms of the world of sustainable finance. Something that our panelists today live in this all the time, probably feel like they're talking about it all the time to the people they know, but something that we really wanted to try to achieve with this webinar, and this isn't, of course, it's just the start, but is the cross-pollination of some of these conversations, because we can get very siloed, be it the energy sector, the transport sector, the financial sector, and the agri sector, and sometimes just having that ability to hear from the horse's mouth what's actually happening, where the trends are, why it's happening, and also that this is an evolving landscape. Just even over the last 12 months, we've seen pretty much all, Rabobank still to come, coming through with sustainable loans and sustainable linked loans, and I think it'll keep evolving as that data and the transparency, and we've heard a bit about the tech as that's moving forward as well. So hopefully today you have got more understanding around the drivers for change from the customer, from the investors and the regulators globally and domestically. Where the targets are coming from, be it from the Net Zero Banking Alliance or from the NDCs domestically, as well as those investor targets they have themselves and the producer targets, reporting requirements, and how the banks are playing a part in enabling that transition. We've heard a lot about taxonomy, which just means definitions, and how, as New Zealand has done that with the Sustainable Agricultural Finance Initiative, that different countries around the world are developing their definitions as well. So that's something that as each country starts to grapple with these things, then also that need for alignment at the global level as well, especially for our multinational companies. And also the benefits and the opportunities for our agriculture organisations that can come through accessing these financing opportunities, how that will impact capital, where there might be opportunities for proving provenance as well, and that with the data chain as well. But that importance of ensuring that our banks are talking with our councils and are talking with our companies to ensure that that data burden is relieved as much as possible. And we've heard that that the banks are continuing to evolve these offerings, and we've got those focusing on climate change, but the nature and biodiversity will be coming in, which is of course a very important aspect for our farmers and growers and our foresters and our fishers out there. So thank you to you all. As Jack said, we've had a recording, so that will be coming out with a survey, and please do fill that in so we know where you might want to know more. And we can keep doing deep dives into this area, because it is a very significant and important part of enabling the transition to a low emissions economy. Thank you very much all for your time, and thank you for your participation, everyone. Cheers.